Joseph Hogue here with another video on the Let's Talk Money YouTube channel. I want to welcome all our subscribers and thank you for taking a part of your day to be here. If you're not part of that community yet, just click on that little red subscribe button. It's free and you'll never miss an episode. I've been investing in real estate since getting out of the Marine Corps in 2001 and love it as an asset class, but I know it can be intimidating for beginner investors. No other asset class has created as much family wealth, but there's also a lot of pitfalls in property investing. So I reached out to one of the biggest names in real estate for our expert interview series. Now, Tyler Sheff is the creator of cashflowguys.com and the Cashflow Guys podcast. He's been a realtor and a real estate investor for over 17 years. He's a coach and a master facilitator of Robert Kiyosaki's Cashflow 101 game. And I wanted to get Tyler on to see if he could show us and share some of his best tips for investing in real estate for beginners. So Tyler, thanks for being with us and offering to share your insight into getting started in that property investing game.
Joseph, I'm so glad to be here. I can't wait to share with the audience. I'm looking forward to it.
Awesome. So, what does it take to really get started in real estate investing? I know you see those 3 a.m. infomercials about, zero down investing and pyramiding up your portfolio and all that. But what's the real way to get started?
Well, I'll be honest with you. And you're right. There's a lot of late night infomercials out there that are pushing this, that, and the other thing. But realistically, it comes down to 4 things. And here's the cool thing. The 4 things I'm going to mention off, you only need one at a minimum of these. You got to have at least one of these. And the one most commonly understood is people think money. And yes, money is required. Not necessarily your money, but you do need money to do real estate deals because you have to have things of value, cash or whatever, to trade for these assets. So money is one of them. But probably one of the most expensive commodities that we need to invest in real estate is time. Time is one thing we cannot manufacture any more of. The good Lord put us on this earth for a given amount of time, and sometimes they giveth and they taketh away. So time is an extremely valuable commodity that should not be downplayed for the beginning real estate investor. Experience is also something that helps, and granted, that's a beginning real estate investor, right? So they don't have experience, but here's the neat thing. You can leverage other people's experience. For example, I've sponsored deals for other real estate investors to where I become the experienced person, which has helped them raise money and put the deals together. I have leveraged the experience of my team, property managers, whatnot, to help me put deals together. And lastly, somebody needs to have the opportunity. And what's cool is, as I said, those 4 things, you only need one of them. Now, if you have the more of those you have, the better. Obviously, it makes things easier and quicker. But if you only have one, you can absolutely invest in real estate. If you've got the time, but you don't have any money or you don't have any credit or experience or opportunity, if you got the time, you can work on the other 3 and leverage the other 3 from other people.
Okay, that's interesting. You brought up an interesting point on the experience part that a lot of times we don't think about bringing in another person for their experience. We think of bringing in an investor or a money person into a deal. But you can just as easily bring someone in, even for a small fraction of the profit, basically pay them out of the returns for them to basically get you started, get you jump started if you don't have that experience and help you avoid some of those mistakes. So that's a great idea. Yeah. What are some questions people need to ask themselves before getting into real estate? Maybe they haven't really asked themselves honestly if they have that time or that commitment. What are some other things they should ask themselves?
I think that people need to first stop for a minute and truly look in the mirror and ask yourself this question: why am I choosing real estate as an investment? Not that there's anything wrong with it. I believe in it. But ask yourself that question: why are we investing in real estate? Are we doing it to solve a short-term or a long-term problem or situation? If we're getting into real estate to solve a short-term situation, what you will find historically is that when people go in with that mindset, the failure rate is high. Because what they wind up getting involved in is short-term speculation plays, which are high risk. And especially as a new investor, those can turn out very bad. On the flip side of things, if you're asking yourself that question, the answer is, well, because I want to build long-term generational wealth, well, then absolutely stick your toe in the water, take some time to learn, right? Find some good, solid education. I recommend, in the pages of books is a great place to start. Kiyosaki has a whole series of books that are amazing, in my opinion. Read those books. That costs you $40 on Amazon, I think, total, and give you a good foundation from which you can build from there on.
Yeah, excellent. And I think that's a great question for any type of investor. Someone uh, in the short-term game with stock investing, probably not going to do so well
Right.
unless they have that miracle trading strategy that no one else in the history of investing has found yet,
Right.
which is a little unlikely. But yeah, looking at that long-term focus is a great idea. And those books, the idea of books, Amazon Kindle, you get great books for 5, 10, even $40. If you're putting down how many thousands of dollars into your first property, take the time, spend 40 or $50 to read some books on and learn from other people's mistakes before you make the same mistakes. Uh,
Absolutely.
so staying on that theme of some of those biggest mistakes, what are 3 of the biggest mistakes you see in beginner real estate investors?
I'm going to say mistake number one, and I hear this literally, Joseph, hourly, that I get emails come in about this, is they believe that they can flip or wholesale their way to success. They can flip houses or wholesale. They say, well, eventually I'll be a landlord and I'll build that generational wealth. But for now, I'm going to flip a couple of houses to build up some revenue so I can go out and buy a rental property.
Sure.
That is a guaranteed recipe for disaster. I can tell you 99.9% of the time, you will fail making that mistake.
Well, and it's too bad because I love some of the flipping shows just as much as the next guy on what is Home and Gar HGTV or whatever they're calling themselves now. Uh, Entertaining, funny, but not real estate investing and not even house flipping. It's a legitimate strategy that some people have used, but it doesn't happen in a week. And when you have those major crises that happen on the show, it doesn't get fixed in 5 minutes.
That's right.
So I think people definitely go into house flipping and real estate investing in general with some pretty big misconceptions.
That's right.
Shows. So what are some of the other mistakes you see?
Rushing in without due diligence. People will buy into the hype. We've got some local companies here that use high pressure sales tactics. They're unfortunately, they're real estate agents. They use high pressure sales tactics to kind of push people into making decisions or in an urgent manner. You got to buy it now, because if you don't, somebody else is going to grab this deal. And when people allow themselves to get pushed, they don't even, and we've had cases where people have bought properties without even looking at them, never sight unseen. And what they find out is deposits become non-refundable, right? So they're out their deposit money, and heaven forbid they actually do buy the property. They inherit somebody else's mess that they don't have the resources or the experience to be able to fix, which winds up another broken property sitting there doing nothing. So rushing without due diligence is absolutely number 2. You can't do that. You got to stop, take a minute, get a professional inspector involved, get an appraiser involved to determine value. And if you're forecasting what that value is, use an appraiser that can help you with that process, especially as a new person. So I would say that would be number 2. And number 3 would be they buy into the hype of easy money. If you spend any time on Facebook these days, you'll see these ads and these trolls that'll pop up in Facebook groups going, hey, I can get you an unsecured business line of credit in 5 minutes. Email me at easymoneynow@gmail.com. People get roped into this. And the problem is that, they'll pay an application fee or something like that. And in some cases, these companies will even help you get a credit card from some unsuspecting credit card company using a tax ID number. People get lured into these gimmicks thinking that they're going to get these big lines of credit. In reality, they're going to get about a $5,000 to $10,000 surprise bill they weren't aware of and destroy their own credit in the process. So there's no such thing as easy money. It takes time, it takes experience, and it takes determination to succeed in this, just like it would in any other form of investing, like you had said.
Sure.
And take that time and realize if it seems too good to be true, I can guarantee you it is. It absolutely is.
Yeah. There's no sure thing, and there's no risk or reward without risk, and that effort, that at least that due diligence, like you're talking about there, and so important. I think people get excited about beginning real estate investing. They get excited about a property, and they make concessions. They go back on what they know they're supposed to do as far as due diligence, checking out a property, negotiating for the price, and basically just jump into it.
That's right.
The agent tells them, oh, I've got 2 or 3 people waiting on this property and making offers. Well, if they're making offers for them, let them make an offer,
That's right.
because any investor getting into a bidding war, probably the winner probably isn't going to be the winner. So
No, it's not.
so how do you how do you go about starting finding those deals? How do you find your best deals? Do you have a process for that, or?
Yeah, what I teach people is instead of getting focused on getting deals, so to speak, instead focus on solving problems. When your mindset is that you're out there in the marketplace solving a problem and you put that out to people, if I say, like, for example, one of my monikers, so to speak, is the real estate problem solver in my market. That when people have problems that either selling their real estate or their real estate are causing, they naturally think of me and go, I should probably call Tyler because he can come up with a solution to this. And do I have the answer every time? Absolutely not. I'm not that savvy, but I do. Once you tell me the problem, I'm good at listening and I know a lot of people and I can use my resources to help folks solve the real estate problem. So for me, what that looks like is a lot of times I actually do get no money down deals. I get seller financed properties because I'm able to listen to what the situation is and then offer a solution that is best for them. When you do that and you create that win-win, I hate to use that term cliche. I know it's a little cliche, but it truly is a win-win scenario. And when you focus on that instead of focusing on what's for sale on the shelf, so to speak, I don't compete with anybody because when I buy a property, I'm the only one there making offers because nobody else knows it's for sale. You see, that's the difference.
Oh, okay.
So I don't have to worry about competition. I just focus on the problems like landlord issues, management, things like that.
Okay. And I think it's great advice also for just for part of the negotiating process is knowing to how to negotiate on other things outside of price as well. Having a list of things that you can offer a seller and things that you want from them to negotiate around the price while still, being able to move that price up and down and get something like that.
That's right.
So one of my biggest mistakes that I made, just out of the Marine Corps, started, and this was right around 2002, 2003. So of course, everybody was getting into real estate because it was going to be the next big thing.
Right.
And I just started buying rental properties, and within 2 years, I had like 6 rental properties in a duplex. Got started so fast that I didn't understand how much work property management really was. And even 1 or 2 properties can be a pretty big job. So do you have any tips? How can investors manage their properties without it becoming a full-time job? So maybe their real estate empire hasn't grown quite to the point where it's going to support them. They need to keep that full-time job. So how do they juggle the two?
Time being a very important and very valuable commodity, one of the first things I'll tell people, and they give me some pushback on this sometimes, is you hire professional management from day one. Here's why. You can then leverage the time of somebody else to take care of that asset. That asset will still generate money. Yes, you're going to have to pay for property management, but here's the cool thing. When you go in with the mindset that in every instance, I'm always going to use professional management, you can build that cost in and negotiate the deal to make sense so that the deal can afford management. There are folks out there that say, well, you can't really pay for management on small properties. I don't believe that's true at all. You can absolutely add that in on the front end of the deal and say, okay, I'm going to keep this for 10 years. So I've got to take off, say, 15% of my income to cover the cost of management and the ancillary expenses that go with it. When you factor that in up front and you simply negotiate harder, but again, if you do it right, you're the only one that the seller's negotiating with because nobody else knows it's for sale. When you negotiate that way, now you've got built-in management. So your time can be better spent going out and finding the next opportunity because with real estate, like anything, it takes more than one to get financially free. That's for sure.
And I love that. I love the idea of building property management, those costs into your thinking, into your negotiation, and your estimated returns for the project. Because not only is that going to give you a better idea of maybe potential expenses, but it's going to push you to only the best investments.
Right.
If you have to have that extra 15% hurdle from property management that you have to cover, then I mean, even if you get into a property and maybe you end up managing it yourself,
That's true.
then, you know, that's just 15% more cake.
One little quick side thing on that is people will hear this and go 15%. That's ridiculous. I got a guy that'll do it for 8, or a guy that'll do it for 5, or a guy that'll do it for 10. Not well, they won't. So
15. You say 15% is pretty well the average, because I used to think maybe it was around 10% was the average.
Generally, most property managers in the small property space will charge 10%. But here's the thing you got to remember: at some point during the year, the phone's going to ring. My water heater's not working. Something. When that happens and they have to do extra duties, they will usually incur a charge. If they're not charging you for that, they should be, because the mark of a bad property manager is someone who is underpaid.
Sure.
When they're paid properly, because the job is no fun, I assure you. So whatever you pay them is never enough. When you pay them well, they perform well, which means less headaches for you. So I build in 15%. Does it cost me that? Not always.
Okay.
But when it doesn't cost that, great. Now I can give them a nice little Christmas bonus. And at the end of the day, folks, you just do the math. What's the additional couple percentage points on the income of a rental property over the course of a year? We're not talking about a huge amount of money. So just allow that extra 5% to happen, change the mindset of the manager, and you got a win-win deal. It's true.
So talking about those returns, and I know we all see these commercials, we all see, you know, on the internet, the flipping and all that. We get these ideas of what you can earn in real estate investing. But what kind of return or wealth accumulation can someone realistically expect beginning in real estate?
Realistically, and I break this up into 2 categories. You've got your active investors and your passive investors. Now, as a passive investor, generally you're putting your money in. Somebody else is doing all the work. You're just leveraging everybody else's time and experience and team to do everything. From a passive investor standpoint, we usually see between 8 and 12% as the norm. There are cases where it's significantly higher, like in syndications, apartment buildings, things like that. It can be significantly higher. That usually results in some commingling of funds. In other words, your money and my money and 5 other people's money would be all in one deal. Mm-hmm. And you can do bigger deals. Bigger deals have bigger profits. It all plays out. From an active investor standpoint, in other words, you're out buying property yourself. You're buying little rental houses, maybe duplexes or 8 to 10 unit buildings. Your returns can start at the 20% cash on cash and go up from there. I mean, I've got deals that I've done with infinite returns. They're 100% funded with somebody else's money. I have 0 money in the deal. And to be honest with you, very little time, because I've leveraged my team to put those deals together. So for me, those deals wind up being infinite returns by definition. But in most cases, you can usually count on 20% cash on cash. If you're not getting 20% cash on cash, I believe you got a very high risk deal.
Okay, excellent.
Anything less than that.
Yeah, and again, back to the idea of pick your deals. You know, walk away from anything that's not that 20% cash on cash, because you know, even if something goes wrong, if you start from that benchmark, even if something goes wrong, you're still only down to maybe 15%, which is still an excellent return when you add in a lot of those tax benefits from real estate that you can shield a lot of your other income from with the depreciation. So yeah, start with a high benchmark and be uncompromising, and
absolutely,
you'll do well. Some great information, great ideas. I want to thank our guest today, Tyler Sheff, for his insight into investing in real estate for beginners. Be sure to check out his blog and the podcast, cashflowguys.com. I'll leave a link to that in the description. When do you do new episodes for the podcast?
Our episodes release every Friday morning at 6 a.m. Eastern time zone.
So every Friday morning, start your weekend right with listening to that podcast. If you want to keep getting great ideas and interviews for beating debt, making more money, and just making your money work for you for a change, don't forget to click on that subscribe button and join the community. If you've got a question for Tyler or myself, ask it in the comments below and we'll make sure you get an answer.